The Roaring Twenties, a market built on illusion. But history echoes. Are we any wiser? Then, the crash. Fortunes vanished in hours. Today, debt dwarfs 1929. The pattern repeats.
October 29th, 1929. In a single day, more money evaporated than the United States had spent fighting the entire First World War. 16 million shares sold. Billions gone. And almost nobody, not the bankers, not the economists, not the government, saw it coming, or admitted that they did.
This is not just a history lesson. This is a blueprint. And once you see the architecture of 1929, you will never look at a rising market the same way again.
Before you can understand the crash, you have to understand what people believed, genuinely, completely, across millions of households in the years before it happened. They believed the boom would never end. What does it feel like when everyone believes prices only go up? The 1920s in America were genuinely extraordinary, not just in feeling, in data.
The economy was not imaginary. It was real and fast and producing genuine wealth. New industries, automobiles, radio, electricity reaching towns that had never had it. The middle class, for the first time in American history, had money to spare.
And then someone pointed them toward Wall Street. By 1929, ordinary working Americans, teachers, factory workers, shopkeepers were buying stocks on margin. That means they were paying perhaps 10% of the stock's price up front,
borrowing the rest from a broker, and betting the stock would rise enough to cover the loan and leave profit. It was leverage. It was legal.
The market rose. People borrowed more. They bought more. The market rose further. More people joined. The loop somewhere in the mathematics of that loop was a trap nobody wanted to name.
Every bubble has architects, not villains, architects. People who built real structures that happen to amplify the instability underneath. 3 mechanisms made 1929 possible. Not 1, 3.
Every bubble has architects, not villains, architects. People who built real structures that happen to amplify the instability underneath.
3 mechanisms made 1929 possible. Not 1, 3.
1. Margin buying. 2. Investment trusts. 3. The myth of the permanently high plateau.
But the trusts themselves borrowed heavily to amplify their returns, and some trusts invested in other trusts, which invested in other trusts, layer upon layer of leverage, each layer making the whole structure more fragile. By 1929, investment held billions in layered leverage positions. A 10% drop in stocks could wipe out 100% of some trusts' equity.
And the third mechanism was perhaps the most dangerous of all: the expert consensus that prices couldn't fall. In September 1929,
Just weeks before the crash, one of America's most respected economists publicly declared that stock prices had reached what looked like a permanently high plateau. Permanently high plateau. In 2026, what phrases do you hear that sound like this? When the most credible voices in the room tell everyone the music will never stop, that is often the last moment before the music stops. Chapter 3. The warning nobody heard. March to September 29. Inside the Federal Reserve, a lone figure worked through the night, poring over documents that foretold disaster, but their warning went unheard. The crash of October 1929 was not a surprise to everyone. The Federal Reserve had been watching the speculation build for over a year. In March 1929, after the Fed warned of excessive speculation, a small crash actually occurred. A preview. Investors panicked briefly, prices fell, then recovered. And the lesson most people took from that was, the market always comes back. March 1929, a minor crash sent a warning. The market recovered within weeks. Investors took this as proof the market was safe. It was the opposite of what it proved. Between March and September 1929, the Dow Jones continued to climb. It peaked on September 3, 1929, at 381 points. That number would not be seen again for 25 years.
25 years. If you bought at the peak in 1929, you waited 25 years just to break even. Behind the scenes, the more sophisticated investors had already begun quietly selling, not announcing it.
Not warning anyone. Just reducing their positions while ordinary Americans, reading the headlines, seeing the Dow climb, were still buying in. The gap between what insiders know and what the public sees is not a 1929 problem. It is a structural feature of every market. The warnings were there, they always are. The architecture makes them pitifully impossible to ignore. October 24, 1929, Thursday morning. The New York Stock Exchange opens as normal. Within the first hour, something is wrong. Borrowers who don't have the cash must sell. Selling drives prices lower. Lower prices trigger more margin calls, more selling. Prices are falling, not slowly, sharply. Margin calls begin firing across the system, brokers demanding their borrowers put up more cash to cover loans now worth less than the collateral. October 24, 1929. 12.9 million shares traded in one day, a record that shattered all previous volumes. The ticker machine fell hours behind. Investors didn't know the real prices. That last point is critical and almost always missed. The ticker tape, the machine that printed live stock prices, fell so far behind the volume that by midday, investors across America were reading prices that were hours old. They were making sell decisions based on numbers that no longer existed. In 2026, information moves in milliseconds. But the question of whether ordinary investors have the same information as institutions, that question hasn't changed.
Gentlemen, the market is collapsing. We must act now. Pool our resources. Buy. It will stabilize the market. Then we begin.
Blue chip stocks at above market prices, visibly, deliberately, to send a signal. It worked for 5 days. Blue chip stocks at above market prices. Chapter 5, Black Tuesday, October 28 to 29th, 1929. The gold is gone, gray and cold. 5 days. The bankers bought themselves 5 days. And then on Monday, October 28th, the selling returned. And this time, nobody was buying. October 29th, 1929. Black Tuesday, the worst single day in the history of the New York City.
16,410,30 shares traded in one day. The ticker machine ran 2.5 hours behind by end of day. Losses in a single day, estimated 14 billion. 14 billion in 1929 equals approximately 260 billion today. In 1 week, the Dow Jones Industrial Average lost approximately 25% of its value. By the summer of 1932, 3 years later, it had lost 89%. But here is what most documentaries about 1929 skip entirely. The crash did not cause the Great Depression on its own. The depression was caused by what happened next, by the decisions made in the weeks and months after the crash, decisions that took a bad situation.
After the crash, 3 decisions turned a financial crisis into a decade-long catastrophe. Not 1, 3. And each one made sense to the people making it at the time, which is the most disturbing part. The Federal Reserve raised interest rates. This action aims to combat inflation. Rates are now at their highest level in decades. Chapter 6. The decisions that broke the world. In 1931, a bank closed its doors. The queue dispersed, a symbol of trust shattered. After the crash, 3 decisions turned a financial crisis into a decade-long catastrophe. Not 1, 3. And each one made sense to the people making it at the time, which is the most disturbing part. The Federal Reserve raised interest rates. In 1931, as the economy was already contracting, the Federal Reserve raised interest rates. The logic: protect the gold standard, defend the dollar. The result: made borrowing more expensive exactly when businesses did to survive. The result: made borrowing more expensive exactly when businesses needed to borrow to survive. Thousands of businesses couldn't refinance. They closed.
The banks failed, and nobody stopped it.
Between 1930 and 1933, over 9,000 American banks failed. When a bank failed, the savings of everyone who banked there vanished. There was no federal deposit insurance. The Federal Reserve, designed to be a lender of last resort, largely stood aside. Ordinary people lost everything they had saved, not in the crash, but in the bank failures that followed. Over 9,000 U.S. banks failed between 1930 and 1933. There was no deposit insurance. Ordinary people lost savings they never invested in stocks. Card 3. The Smoot-Hawley Tariff. The Smoot-Hawley Tariff Act of 1930 raised U.S. liabilities to protect American businesses. It triggered retaliatory tariffs from other countries, worsening the Great Depression. In 1930, the U.S. government passed the Smoot-Hawley Tariff Act, imposing heavy taxes on imported goods to protect American industry. Other countries retaliated with their own tariffs. Global trade collapsed by roughly 66% between 1929 and 1934. Countries that might have traded their way toward recovery instead watched their export markets disappear. Trade wars, tariffs, central bank decisions made in crisis conditions. The tools are the same in 2026. The only question is whether the decisions are different. By 1933, U.S. unemployment had reached 25%. 1 in 4 Americans who wanted to work could not find work. Not because of the stock market crash. That happened in 1929. Because of 4 years of compounding decisions that turned a correction into a collapse.
We'll get through this, together.
I know. We have each other.
That's all that matters. What does the paper say? It says things are hard.
We'll manage, like always.
Together we will.
I know.
Every financial architecture discussed in this series, Bretton Woods, the Bank of England, the 1929 crash, ultimately lands on a kitchen table. That is where it becomes real. In 1929, only about 16% of American households were directly invested in stocks. The majority of people who suffered through the Depression had never bought a single share. They lost their jobs because businesses lost customers. They lost their savings because their banks failed. They stood in breadlines not because of what they did, but because of the structure of the system they lived inside.
By the end of 1929, 2.5 million Americans were without work. By 1933, 15 million, 1 in 4. Most had never owned a single stock.
The architecture of financial systems is built at the top. The consequences land at the bottom. This is not a political statement. It is the observation that 330 years of financial history, which we have now documented across 3 episodes of this series, consistently confirms.
We saw it with the Bank of England. We saw it at Bretton Woods. We see it again here. The pattern does not change. Only the scale changes.
Understanding this architecture isn't about predicting crashes. It's about knowing where you stand inside the system. That's what this series is for.
Glass-Steagall Act 1933 separated commercial banking from investment banking. Banks couldn't gamble with depositor savings. Securities Exchange Act 1934, the first real federal market regulator.
Securities Exchange Act 1934 created the SEC, the first real federal market regulator. FDIC 1933, Federal Deposit Insurance.
60 years of relative financial stability. Then, between 1999 and 2008, several of these structural protections were weakened, removed, or outrun by financial innovation faster than regulation could follow.
The 2008 financial crisis was not 1929, but it rhymed with it. The same mechanics of leverage, the same layered complexity.
The same gap between what the public knew and what the institutions knew. The same pattern of private decisions becoming public consequences.
In 2008, the U.S. government committed over $700 billion in NBER attacks of the crisis were bailed out. The ordinary homeowners largely were not.
2008, the U.S. government committed over $700 billion in bailouts. The architects of the crisis were bailed out. The ordinary homeowners largely were not. In 2026, U.S. household debt is at record levels. Margin borrowing in equity markets is near historic highs. AI is now making trading decisions faster than any human regulator can observe.
The specific assets are different. The architecture underneath, leverage, belief, and the gap between institutional and public knowledge is the same.
3 episodes, 3 architectures, 1 pattern. Let me name it plainly. Financial systems are built by humans with interests. They are presented to the public as neutral infrastructure. They work until the gap between the system's design and the reality it operates in becomes too wide to ignore. Then they crack. The crack is called a crash. They work until the gap between the system's design and the reality it operates in becomes too wide to ignore. Then they crack. The crack is called a crash or a crisis or a correction. The architecture is rebuilt, usually better, until the next gap opens. 1929 teaches us 3 things that no amount of financial sophistication makes obsolete. 1. Leverage a leverage in assisting. Gains feel permanent. Losses are sudden. Financial systems are built by humans with interest. They work until the gap between the system's design and the reality it operates in becomes too wide to ignore. Then they crack. The crack is called a crash or a crisis or a correction. The architecture is rebuilt, usually better, until the next gap opens. Consensus is not evidence. In September 1929, every credible expert agreed the market had reached a permanently high plateau. The architecture of consensus is not a safety net. It is often a sign that nobody wants to be the first to say what they can all see. The consequences land furthest from the decisions. The people who built the leverage, ran the trust, and managed and lost money in 1929. The people who lost everything, savings, jobs, homes. Most understanding the architecture is not a luxury. It is the minimum you are owed.
The crash they never fully explained? Now you know the architecture.
This is the 3rd documentary in the Architecture of Capital series. If you haven't seen the Bretton Woods and Bank of England episodes, they're on the channel, and they connect
directly to what you just watched. Subscribe so you don't miss what comes next, and leave a comment with one thing from 1929 that you think sounds like something happening right now. I read everyone.